Welcome back, everyone, to Vox Markets. My name is Paul, and by popular demand, I am delighted again to be able to speak to Laurence Hulse of Gresham House Strategic, one of the smartest and most activist investors in the UK. So welcome, Laurence.
Thanks for such a warm welcome, Paul. It's really good to be chatting stocks again with you today.
Yeah, well, 7 months ago, when I asked you what was your outlook for equities, you were pretty bullish, and that was a fabulous call, in fact. In fact, I think the Gresham House portfolio was up over 25% during just that period. But given a lot of the easy money has just been made, particularly on the reopening trade, what's your view for small caps going forward?
Well, as you rightly point out, it's all been a bit unprecedented, isn't it? And markets have really been coming home, really, especially in the UK, to sort of steal a phrase that's in use at the moment. If you look at where we've come over the past 2 years, really, from pre and post pandemic, sort of pre what's gone on, you had Brexit uncertainty, political logjam in Westminster with Boris and hung parliaments and whatnot, the unwind of the sort of Woodford debacle and what went on there, and a real dominance of tech stocks. We're now sort of 2 and a bit years later coming out of a global pandemic, which in the meantime has triggered unheard of levels of fiscal stimulus, a building up of record consumer demand and sort of spending power, where we have just been locked up and not been able to spend salaries and wages and whatnot for so long, and talk of return of inflation. So it's been a real journey for small caps. And I think in terms of an outlook, there's a real debate coming, isn't there, which is interest rates and inflation. And I think it's a question that will really define both markets, but the economy and elements of society for the next few years. What are we looking for? We're very much still focused on pockets of value in the market where we can find it. Tend to be cash generative companies or good tangible asset backing. We're trying to avoid some of the slightly hyped areas that you've seen pop out in this unprecedented period.
So you haven't been investing in SPACs then?
No, certainly not.
So what sectors do you like then, Laurence? What's your sort of preferred? I see media and advertising has been featuring quite heavily within your sort of activity levels over the last 12 months. I guess because it's been beaten down and unloved, and they've now got a nice sort of kick through the reopening trade. Yeah,
it's quite an interesting observation you made there, Paul. I mean, if you look at the Gresham House strategic portfolio over 5 years, it's been dominated by sort of tangible asset and cash generative companies, which has lent itself to sort of energy and industrials, especially with our value bias, little G and Northbridge at floating, etc. But as you say, the pandemic really punished the media sector. Those discretionary spend budgets on campaigns and advertising and branding, they're the first things to go in periods of uncertainty, of which we've just been through the biggest for a generation. So that really created some value opportunities for us in a sector we hadn't been able to fish in for a while. So you'll have seen National World and M&C Saatchi come into the portfolio over the past 6 months. And we also topped up, including very recently, things like Bonhill and Centaur. So we have got a little portion of the stable now in that sector, as you say.
Yeah, I mean, I saw that you had 2 things, which just sort of the economic backdrop. You had the CBI on Friday saying that the GDP in the UK was going to rocket this year to 8%, and then another 6%. And I think that's sort of like slightly higher than the Bank of England. But what was really interesting, there was a big marketing study saying that advertising next year, this year, was up globally 19%, but in the UK it was up 24%, mostly dominated by digital. And I think that's been driven by 2 things, largely, obviously, me and you buying everything online, and therefore people wanting to actually advertise to us online because that's going to carry on. And then lots of startups, small businesses who have got no route to market other than through online. So how do you see that playing out, let's just say, with Bonhill? Because it's got some quite interesting internet real estate, hasn't it?
It does, Paul. I think just to pick up on that recovery point there, because it's so key, we do put stocks on a situational basis, but the market backdrop is a key part of how they're going to perform, of course.
Yeah.
Okay? And that 7 to 8% GDP number for the UK, that's a sort of aggregate figure of loads of components, of which one is advertising. And that's going to be an area where the UK economy is going to really over-index.
3x, according to the experts.
Yeah, double-digit growth this year and sort of up to 10% next year, more than recovering the losses from COVID. So that's what sort of caught our attention in the depths of the crisis. And, Bonhill, as you say, one example is a way to capture that. There's a valuation opportunity and a recovery opportunity there.
Yeah.
So if one looks at Bonhill, fair value well into the 20 sort of pence per share. It did £25 million worth of acquisitions pre-COVID. The current market cap's 13. So there's a gap. Either they overpaid before or they're trading too cheap now. And, obviously we've been topping up, we're of the view that the current shares don't represent that intrinsic value in the business.
Yeah, well, that was your call of the day, wasn't it? Because I think that was your number one stock pick 7 months ago. And you bought it in at that sort of 5p, and it's currently trading at, 13, 14p. So you've more than 2x your money. But you say, if you still think the valuation is well north of 20p a share, do you?
We do, yeah. There's a sum of the parts argument that can get you easily above 20p from here. I don't want to give away too much of our secret sauce. But I think if your listeners go and look at, as I say, one way is to look at what they've paid for businesses in the past. At 5p, it was on 2 times normalised EBITDA.
Yeah.
At sort of 13p, it's on 4 and a bit. We all know media businesses can trade higher than that. M&C Saatchi, one of the deals we have done more recently, it's the last big position we took around Christmas time. There was a load of sort of stock-specific issues there that had to be addressed and created the valuation opportunity, which we can come on to later. But that is a real play on their digital recovery, because they not only have they already got exposure to digital services for their customers, it's a key part of their revised strategy is to expand that. So you can sort of double dip on digital there with that one. And it's still coming out of, a real couple of tough years that business had, but some really, people like Vin Murray are getting involved.
It's got a heavyweight list on the board, isn't there, on M&C Saatchi? It was the brand. What do you think of the brand? Because obviously it was enormous back in the 80s. Maybe before you were even born, but I remember they came out with slogans like "Labour's not working," and they were sort of like really in for the Conservatives. And they just were hand over fist the sort of top advertising agency in the world, and it seems to fall on sort of like hard ground. Is there a chance that you can get back to those glory days?
Well, you've pointed out the example as a politics student at university. I was going to bring up the old sort of
Labour, were you? I'm sorry.
Labour isn't working. Big sort of billboard. Look, I guess in terms of what the business has been through, it did have those heydays in the 80s and 90s, and I don't think anyone is modelling a return to that. I think the world's very different, and the people running the business are very different now. Over the more recent times, the business was a bit slow on transforming its business model from the old sort of Mad Men 80s, 90s days, where campaigns like that were the be all and end all. You and your listeners will see there's been a big change at the board level, but crucially at the management level as well. And that's been a chance to act as a catalyst to reset the strategy. So I guess Mickey Khalifa coming in as FD has cleared up the accounting issues.
Yeah.
We've got a real clear plan on improving the cash generation and the margin profile of the business. Maureen McLennan, the CEO, has worked there sort of 20 years, but offers a sort of breath of fresh air as a new chief executive. The previous 3 amigos who ran the business for sort of a couple of decades have been...
The 3 amigos, I like it.
That's what they were called.
That was it, okay.
Yeah, I made that up.
Okay.
I don't know if they referred to themselves as that, but it's definitely what they were.
Yeah.
Well, they were known, who they were known as. But they've got a sort of margin recovery target of getting the business to sort of 18% EBIT margins. I have to say it's ambitious. There's a really smart board there. We've obviously sense checked those targets, but when you consider they're delivering margins of, I think, 4% this year and 6% next, even if they get to 13, 15%, there's a real earnings accretion story there, which I think, we've certainly subscribed to. And I think they've done a good initial job on reducing some of the dilution from the old option schemes. And, I think there's been some commentary that they may use future cash resources to try and minimise that dilution further, which leaves, of course, more equity value for existing shareholders.
Yeah, one question I know investors do have about M&C Saatchi is there is an actual drift across the industry for large corporates, your big Unilevers, your P&Gs, who used to be their sort of like, bread and butter customers, to insource a lot of their media advice and stuff like that. And is that something that is, could damage the business, or is that something they're playing to their advantage?
Look, I think you're right to point it out. And back to my comment a few minutes ago, we're not modelling a return to the kind of glory days of the 80s and 90s.
Yeah.
We're sort of, the share price became heavily depressed by the time we got involved at sort of Christmas time at 80.
Yeah, I see you've doubled your money already, haven't you? Again.
Yeah, and I think, it's not one of the big super Ogilvy style level size players. It's more of a mid-market player, M&C Saatchi nowadays.
Yeah, okay.
I think if they can monetize some key accounts better, simplify the operational structure, this is more about earnings recovery than backing them to go and win lots of new mandates. Of course, there'll be some earnings growth, but sort of low single digit we're modelling. It's more about margin recovery here.
Yeah. Self-help, which is a sort of key theme, isn't it, basically, of a lot of Gresham's?
It is, certainly in the Gresham House strategic portfolio, Paul. One of the ways we think about it. Change, whether it's strategy change, management change, operating model change, sort of by definition has to affect the earnings and rating of those earnings, i.e. the share price in some way or another. Now, it's sort of our job as fund managers and a team and an investment committee to work out if they're good changes and they're going to have a positive impact on the earnings. But as you say, we quite like self-help because it's change that's in the company's control.
Yeah, I agree.
Market event-driven stuff can be helpful. I mean, there's one company, sadly, I can't mention them because we haven't got a stake yet, but I've done... because the
Gotta twist your arm a bit.
As soon as it's out, we'll have a follow-up. But
okay.
Because the management team is so strong, on that one, we did spend loads of time on the market opportunity, and that, it's obviously really important defining the margins in which the company can operate. But
yeah,
we find it much easier to model and analyse self-help initiatives.
Okay. So basically, you're controlling your own destiny then and driving value, aren't you?
Yeah, I mean, we're not trying to come in, and I'm certainly not, to our investment committee or teammates saying, I think I understand the EV market or the construction market better than anyone else. I'm not, it's just not feasible. Yeah. What we do like to think we're good at is analysing strategies, plans, and sort of 3 to 5 years, what are you going to do to the earnings? Why is that going to drive a better rating? And if you get those two things combined, it can achieve those sort of 2x, double your money situations you've mentioned.
Yeah, a couple of other ones in the sort of the media and advertising space that one was a news position, another one is a sort of one you talked about last time, is National World and Centaur Media. Can you just run through that? I mean, let's start with National World, because this is absolutely straight out the sort of the value play, isn't it? Because didn't they buy the old Johnson Press business that I think came out of bankruptcy actually at one stage, and it's sort of the Yorkshire Post and I don't know, some really strong sort of local newspapers.
That's completely correct, Paul. It's sort of, this one was kind of value on value because the team led by David Montgomery actually they picked up the old Johnston Press assets, as you're right, for sort of 10 million quid when pre-COVID there was a kind of bidding war at around 40 million, of which the PE owners rejected. So they ended up with a kind of 75% discount, and then we got involved sort of pre-IPO, convertible loan note structure, which
is converted
at 11p. They're already sort of 19 to 20 today.
Not a bad bit of work.
What's interesting there, you've got a team with a credible track record at turning around and monetizing some of these assets that have had a really tough decade. Okay, things like the Yorkshire Post, the Scotsman, we sort of subscribe to the view that there's been a bit of a trend going on in the economy of sort of regionalisation, levelling up. I think part of Brexit was all about a decentralisation from the southeast and London. And if people are thinking that way, perhaps they're going to consume media that way. And if you own the Yorkshire Post, the Scotsman, all these regional titles, and have a good plan to make them more interesting and accessible, there's probably a good chance to improve the returns from here in those assets. So that's one key part of the thesis. And then the other is they are going to take out quite a lot of costs. So, for example, one of the Scottish titles was being run from sort of 50 miles away by an editor in a swanky office. COVID's allowed them to totally turn that on its head. They're now someone working remotely in the region in Scotland.
Yeah.
So it's cheaper, but also arguably sort of more effective and so certainly better value for money. I think on that one, we'll be monitoring it from here. It's had a really good start, and now we're looking for they've made the progress on the costs. I think now is evidencing that strategy to monetize the assets. I mean, it's quite interesting. In the US, quite a few hedge funds have been picking up similar assets like this.
Yes.
On a sort of distressed basis with the view that there could be an inflection point coming, and we're sort of all ears and eyes now looking for more of that.
Yeah, I mean, I think you buy at such a cheap level that it builds in so much bad news, and even if they struggle to do what you even remotely hope they do, it's still you got such a wide margin of safety that you're unlikely to lose your money. It gives you huge downside protection, doesn't it? But it's all upside. So even if they do nothing, you're likely to actually make a very good return anyway.
Margin of safety is certainly a key part of our process and the way our sort of investment brains work. But patience is too. And look, with this one, the self-help cost work's being done.
Yeah.
I think you're now going to have to be patient to get that digitization to be implemented, costed, but then sort of bear fruit. I mean, it took the New York Times took sort of 6-7 years to really double its digital revenues. So, the Little Yorkshire Post or the Scotsman, it might be more bite-sized and manageable, but it's not a sort of as big a bat to swing. So we're going to be patient on it, but there's a good team, a good track record, and it's kind of, as you say, the margin of safety in the price.
Yeah.
You don't have to set the world alight for us to make good returns for our...
Yeah, it's still an 80-20 rule with print versus digital, isn't it, I think? And the one thing, again, I think investors would be interested to hear is such that, there are very few old print titles which actually make any traction at all online. You've got the FT, Wall Street Journal, very financial specialized. We're talking B2C titles here, not B2B. And then probably the Daily Mail with its online, but those there are few and far between. I mean, I don't know. I don't think the Telegraph or the Times make much money online.
They don't, but there is sort of growing improvements. So Reach have been doing a really good job at sort of digitizing and monetizing. Local World.
Yes, you're right, actually. Yeah, I get lots of their emails. You're right.
There are, I agree, at sort of the headline level, and certainly to date, the proof in the pudding has been mainly with things like the FT.
Yeah.
But, there is some creative thinking going on. So actually at National World, they're experimenting with a sort of pay-as-you-go, pay-as-you-play model where rather than demanding you sign up for kind of a monthly fee that may look a bit intimidating to sort of your average consumer, there's a view of, okay, well, you could pay 50p or £1 for one article, see how you go. So and as I mentioned, Reach is getting traction as well. So I think, we're all at home more. We're not around to buy a newspaper anymore. So we're sort of going to have to consume media more digitally. You've got the Apple News stuff going on. It's definitely a market in flux. And those are the kind of, as I said earlier, change creates opportunity for upside and improving returns. And we as the fund managers try to work out if it's going to be good or bad change. And hopefully,
I agree. Well, I'm one of those saddos who just consume news left, right, and centre, and I spend a subscription on the the FT and the Wall Street Journal and Barron's and Investors Chronicle and all that stuff. But I do actually use the frees quite a lot, i.e., such as the BBC. And therefore don't need the days. But anyway, moving now on to the B2B side, can you just quickly drop through a bit on the Centaur Media, because that's a B2B play, isn't it? Which has got digital assets and sort of like consultancy associated with it. And again, I think you talked quite favourably. They own the Lawyer, don't they? And they've got some sort of other big marketing brands.
Yeah, so in fairness, Centaur is one we've held for quite a while now, but did top up very aggressively in lockdown, just the valuation opportunity. You've got actually, it's another sort of sum of the parts case, really, which is quite a way we like to think about a lot of our investments. The Lawyer, if you put the Lawyer, which is their key title, so sort of trade mag for the, funny enough, the legal industry, you put that on sort of 8 times, which is not a punchy valuation to display. If you look at what Future Group and that pay for some of these magazines, it's not too punchy.
8 times EBITDA.
Yeah, it gets you about to sort of 40 million. The market, the EV of Centaur today is about 53.
Yeah, okay.
You're almost assuming that, the market's valuing the remainder business at 13 million.
They've got about 8 million of cash, haven't they?
Correct, they have. Yeah, which gives you attractive EV, some of the parts opportunity.
Yeah.
Swag, who's a well referenced by us, ex-finance director now running the business. He's got quite a detailed plan, again, self-help, to get them to 10 million EBITDA as a group. Now, you put it on 8 times, 9 times, 10 times, it's certainly well in excess of an EV of 53. So this is one where we're monitoring a self-help program led by people we reference quite well to drive better returns and valuation. Is Centaur for the long term always going to be Centaur? I don't know. They're sort of halfway through. If you track the history of the business, they've been selling off assets opportunistically. I've mentioned the lawyer. They've got other brands in there that I think at some point, that 100 million valuation on the screen, you've got some quite active shareholders on the register now. You might see a push to monetize and crystallize that. And
right, okay.
If you sort of see what I'm driving at there.
Yeah, and is there a danger? I mean, you've got obviously you've gone sort of like full bore into advertising and media and done really, really well. Is there a danger that the portfolio becomes more sort of like, heavily weighted or lopsided into advertising and media, particularly when they increase their market cap so much? And I don't know what your percentage is now in that area.
We do run a super concentrated portfolio, as you know, Paul, and we invest in situations, not sectors. But we have, because of this thing, this what I described earlier around media coming under pressure, we have ended up with about a 20% weighting.
Okay, so it's not too bad.
Which we're comfortable with, given the upside. We just discussed, the record 2 years coming for advertising recovery. I probably wouldn't be putting any more media stocks into the portfolio here. I think we've got in a good time. We've got good exposure, and then I guess offsetting it as well. The rest of the portfolio is very different to media, so not people businesses at all. We've got things like Aegean.
Yeah, we'll come on to all these.
Flowtech, Northbridge, they really are the polar opposite of kind of going to M&C Saatchi's offices in Golden Square.
Yeah. Well, one sector you don't have a huge exposure seem to is healthcare, and that seems quite odd in the fact that we're going to a golden age of medical science going forward. Is that just because you don't see any value cash generative businesses in the small cap? I mean, the cash generative being the sort of the key trait for it.
Look, I think. You're right there, Paul. There's definitely value in the healthcare sector, and some investors I admire, people like Chris and Nick Mills, James Williams. They make cracking returns from some of those stocks. Being completely candid, one, they're not mine or my colleagues' sort of specialism or skill set. We don't have much of a long track record in investing in them, so that's sort of one question mark. But two, as you say, we do have an investment mandate focused on cash generation, value versus intrinsic value. It is quite hard to sort of model an intrinsic value of a healthcare stock, especially when it's sort of...
It's a leap of faith.
Yeah, so a little bit for a concentrated portfolio like ours with a lack of that kind of inherent knowledge and skill set. It's just something we stay away from. As you know, we're sort of much more focused on the industrials, bit of media now. We've got some software and technology. Yeah,
we'll come on to that in a moment. Well, one thing, I have to give you, sort of like a lot of credit and a big pat on the back and a big thanks from me, because I'm an owner of a shareholder in Northbridge, and there's been a lot of sort of like strategic developments and improvements, and it has all the hallmarks of behind the scenes, a bit of sort of like shareholder support, sort of moving that direction. Can you just walk through what your view is of Northbridge and how you see it? Because I understand you've now converted your loan into stock or into cash. You've paid down in cash, but you're still by far and away the largest shareholder. And obviously there's been lots of very positive developments, and I think the shares since we last spoke are up about 60%. So you've done pretty well both areas.
I think so. With Northbridge, it's actually one of our longest holdings or longest duration holdings in the portfolio now. First invested in sort of 2016, actually. At the end of the last oil and gas cycle.
Yes, exactly.
We come up against another one a bit earlier than we expected. I think at the time we identified two businesses in the Northbridge group, Crestchick and Tasman. Tasman, oil drilling, Crestchick load banks, which for people that don't know is big sort of shipping container sized generators and power testing units, which are important for when you're constructing a ship or a building or a power network to sort of effectively put it through its paces to simulate that to flush out any errors or short circuits.
Yeah, it's testing backup power supplies, isn't it?
Now, the value opportunity originally came from an oil and gas recovery because Tasman was exposed to that, as was Crestchick. Interestingly, what COVID's done is really opened up much more of a power markets opportunity than originally, fairness, back in 2016, any of us sort of modelled. And what's driven that is the ESG drive and the drive on renewables, looking to connect basically society and the economy, whereas it was, a lot more combustion engine focused. Over the next 10 years, there's going to be connections everywhere, from sort of solar panels, wind farms, car charging points.
Yeah, EVs.
All that stuff. So what we've you'll seen from some of the announcements, there's been a slight tactical shift or strategic shift at Northbridge where, Tasman is now going through a disposal process because it's very much more oil and gas focused. They broke out in the accounts for the first time, which we were really pleased to see, was the return on capital employed for the two divisions.
Yeah.
And what that flagged was 22% ROCE at Crestchip, which is kind of best in class, cracking return drivers. And then, unfortunately, Tasman's never really recovered from the last oil and gas scarring. So what we're pushing for is, what the company is now moving towards is a much bigger focus on connections and power through the Crestchip division. And there's been strategic change, personnel change there, all to try and really grab with both hands a really exciting earnings opportunity there for the Crestchip business. And they've got so confident they're now they're doubling sort of factory capacity at Crestchip.
Yeah, up 50%, isn't it? They're going to increase it by
50%. You're right. Yeah.
Yeah.
And hence we had some loan notes in the business. We redeemed about 80% of them into cash because we get quite an attractive interest rate on that.
Yeah.
And then converted 20% into equity because we do see material upside. Now, the reason why it's 80-20, I've got a job as a fund manager to construct the portfolio in a good risk-reward manner. And we'll have a sort of 8%, 7.5% weighting in Northbridge post converting just 20% of the loan notes because we already had an equity position. I didn't want to kind of bet the farm on one stock. So that's why we took the cash in hand. One bird in hand is better than two in the bush sort of thing.
Yeah.
And that gives us capital to deploy into the next set of opportunities when markets inevitably at some point have to correct after this.
Or you see specific opportunities, isn't it? A company needs a bit of the sort of the Gresham magic on it. So gives you an opportunity, gives you some, sort of like opportunity cost there.
Yeah. I mean, one thing I've got my sort of eye on is, interestingly, there is a generation of finance directors at some of these PLCs now that have never had to run or forecast the business through an inflationary period. And I'm sort of slightly conscious that we might get, I think we've had one or two already actually, but there could be back end of the summer a few inflation-driven profits warnings where people slightly got caught, and that might be a really good opportunity for us to put the next set of capital to work.
Yeah. Well, I saw you did put a bit of cash to work in another one, which is, I mean, you're not scared to go real micro, are you? I mean, obviously, Bonhill, when you first put it in, was a sub 10 million. Another one which was sub 10 million is ULS Group. Now, I think that's a sort of like a technology, it's a software sort of hardware solutions business for petrol forecourts and convenience stores, and has some sort of like big clients and stuff. And I ran the numbers on this one, and this is the most frighteningly undervalued stock I've just about ever seen for a potential software. I mean, it's still... The shares are about 5 2/4 p, and their market cap's 14 mil. But they could be hitting the ball. If you look at they could be hitting over 20 million a turnover.
I'm going to be super careful not to steal Neil Radley and the rest of the new team's thunder because they've sort of said they're halfway through.
Yeah. Okay. Yeah.
There are things I can talk about. So what have we identified in the business that could be attractive and interesting as a shareholder? Really strong element of recurring revenue. So I think they've got sort of 14 million. 60%
recurring revenues.
Yeah, I think 14 million of the 20 revenues that they would do in a normal year are recurring.
Of which most of that is software. 50% of that business is software, I understand. The rest is sort of hardware and solutions.
Yeah, and it's software with proper players. You'll have seen things something that's given us comfort. A number of RNSs of contract renewals with some pretty major household names. If you go into the investor deck that's available on their website, you'll see, Esso, Morrison's, Asda. These are serious businesses that they're able to service, and they're kind of asked to service again. So we're just wondering, is there hidden in there something to monetize a bit further?
Adjacent markets,
or they do serve some customers only in the UK that have European businesses. The UK market itself is quite fragmented, that sort of fuel, retail, corner shop payment part of the market. And Neil Radley's got a cracking CV. I'd encourage, go and sort of look him up. For a business of this size, we were super pleased to see him wanting to get involved, and sort of met him pre-signing up, and we're delighted. And of course, Graham Bird, one of my former colleagues and member of the IC, has gone on the board as well. And the reason for that was twofold. One, so Graham knows how investors work because he's been a fund manager. But once upon a time, he actually ran, I think it was pay by phone, which if you ever park in London, you can curse his name for that. But
get robbed by phone by me.
But obviously, Universe is a payments business for fuel pumps and petrol stations and corner stores. Quite a lot of good, useful operational knowledge there as well. So you've seen him join the board, and it's now over to the team to come back to us with a kind of 3 to 5 year strategy of how we take what must be some quite good underlying IP to keep Morrison's, Asda, whoever is happy. How do we then take it to the next level and I guess go for the rest of the universe?
Good one. So, I mean, with Universe, I mean, I think it's got a huge. I mean, looking at the numbers, just for the financial, but there's a huge margin of safety in there. It's got good stickability, so the software is, it means that it doesn't actually, it doesn't get kicked out of customers because it's really useful and valuable and difficult actually to remove. So that's great. That ticks the box. One thing, just in the long term, how do you model into the long term? Because petrol forecourts probably won't be around when we have electric vehicles in sort of 5 to 10 years' time. Admittedly, hey, who knows where we're going to be? But it's good. I don't see petrol forecourts with a large tank underneath it being converted into electric sort of like places. You're going to get them in your house, aren't you? In other sort of places.
No, I think it's a really astute point, Paul. And I guess the way we thought about it, a long time ago now, I sort of remember as a child this sort of happening. Petrol stations stopped being just petrol stations a long time ago. They're a convenience retail destination that you can fill your car up while you fill your.
Yeah, I used to go there for Haagen-Dazs.
Fill your basket. I mean, it's one of my pet peeves. The amount of times I go to fill my car up and then just keep on people doing the weekly shop. It just drives me insane. But so I think I think those destinations will continue to be a location where people pay for goods in some form, whether it's fuel or Mars bars or milk or a loaf of bread. I don't know. I'm not going to try to guess, but I'm confident that sort of real estate, that retail real estate, especially if high streets continue to wither away, that will always be there. So that's one point. I think the other, it is, the heritage is in fuel forecourts, but they've been winning contracts with the likes of Cost Cutter.
Yes.
As I said, Morrison's, who, whilst they have retail units at petrol stations, they also have the local, the Tesco Metro or the Mini Morrison's or the Cost Cutter to go or whatever they call it. So, and again, as I sort of alluded to a couple of minutes ago, they've got a great existing customer set, which part of it is fuel forecourts. But what we're sort of looking for and pushing them to do is think a bit bigger and better. And what else could they go for, as you say, in adjacent verticals?
Or just land and expand a bit more in those customers, isn't it? Use a lot. I must admit, I do understand their software. They bought a company, Celltech, about 2 or 3 years ago, and that is apparently super good in terms of real time transaction analysis, not data, but analysis, telling shop managers what is being sold at what price at any particular second, so you can get really micro on it if you need to managing returns on each product.
I think those sort of analytics are going to have increasing value to their customers beyond just the sort of typical processing of the payment itself. And you're right to identify. Look, I think Universe would be the first people to admit the Keltec acquisition was actually quite a quick and cost-effective way of improving their own technology rather than sort of do it from scratch with all the risk and execution risk that involves. They're able to sort of find two businesses that were stronger together than standing alone.
One's just coming into the final stock to tell me, again, it's a software business, is ULS Technology, and a prop tech type of company that is really having a boom time because obviously the housing market, number of transactions has been going literally through the roof. You just look at the stats. How do you see that one? I mean, it's still looking pretty cheap because it's got a shed load of cash. I don't know what it's going to use it for, presumably acquisitions or something, or even pay dividends to its shareholders, eh? Wing, wing.
No, I'm glad you brought it up because it's been a cracking performer for us, and I think there's quite a lot of exciting stuff to come from this business. I think you're right to identify the helpful market backdrop, but that's actually not why we invested. This was one we bought pre-COVID, sort of back in, I think it was November 2019, so just before everything changed forever. But I think what's going on here is this is a software business with bags of potential.
Yeah.
With a great team that just wasn't priced like one. It reminded me in many ways of IMI Mobile, which is one of our top performing investments we held for a number of years. So yeah, ULS today has a market cap of 56. It now has 24 million of that is cash, so half.
Yes.
And that's come from disposing of the CAL division, which we identified as a potential asset to dispose as sort of, it was cash generative and profitable, but not non-core to the future. They disposed of that, and that's created all this cash in the balance sheet. So of that 56, 24 is cash. So you've got call it 30 of equity value. For that, you're getting the e-conveyancer business, which generates 5 million of EBITDA.
Yeah,
so,
and that's 6 times EBITDA multiple,
which is optically cheap.
Yeah.
But then you've got the real exciting bit is this digital move platform that they're sort of developing and rolling out, and it really is, its USP is to make, as I'm finding out myself now, rather unfortunately, the moving house process, all the paperwork, it's really making that quicker, more convenient, more secure. And the cherry on the cake has been post the disposal. They brought in Jesper, the new chief executive, who I think is going to go down really well with the market. He's got a cracking CV working for people, the likes of HSBC on software platforms that face the consumer in the finance sector. He's going to really use that cash to turbocharge, I think, the digital move business and create, one of the leading UK housing software platforms. I'd encourage, that is a business that there's not many pockets of value like this in the UK market anymore, given what's gone on the past 12 months. But here you've got, you've got one software business trading on 6 times EBITDA, and you get another one
for free,
the most exciting, for free. Now, obviously, that pile of cash, that 24, is going to be invested into the digital move business, and that's the judgment call we've made and others have got to make. But I think their finals are due out this month, or
pretty close, 29th, I think.
So we're not looking for dividends there, but we will be looking for a proper rollout of here's what the next 5 years look like. Here's how we deploy the balance sheet assets, and here's what that can mean for shareholders. And you don't have to get to a massive EBITDA number on a 10 to 12 times multiple, and the market cap just starts to look fundamentally wrong.
Yeah, just on that one, I mean, what's quite interesting, let's just assume that really goes gangbuster, the whole digital move side of it. Their traditional customers, as I understand, for the e-conveyancing are obviously through distributors, the big mortgage boys. It could be Lloyd's, or it could be some of the sort of the money supermarket, .com, these kind of guys. If they go for digital move and basically have an end-to-end solution, how are they going to start selling stuff that might compete against their distributors? And if that's the case, then was there a unbundling opportunity if they shoot the lights out with digital move?
Well, I think the core proposition is it's making the overall consumer's experience a lot better, and that's why these mortgage big boys love something like digital move, because they can make it almost part of their sort of.
But it's only conveyancing currently, isn't it? E-conveyancing. It isn't selling them utilities. It isn't selling them mortgages. It isn't selling them all the other financial shebang which goes with moving your house.
It's only conveyancing at the moment, and I think they want to get their bread and butter right first. But Jesper's super ambitious, and as I've said, I suspect there'll be, it would be a natural point to update the market with the finals. More detail on the strategy. If Paul, you've obviously sort of spotted that potential opportunity, I suspect in the boardroom they'll be having similar kind of. They'll be wanting to maximise what they can do with the platform, and that's.
This sounds as though it's another Russian doll type of company, isn't it? You pushed out Cal, and then you've got these 2 real high growth businesses that may sit better on a standalone basis if they really are successful. So that's definitely an upside possibility.
I think that's fair. Look, we're all aware there's loads of private equity interest. Even this morning, there's a couple of things on the screen in the UK market. We all know software platform businesses are real assets to covet for private markets. And if they could get this thing at scale, washing its face, growing like gangbusters, you can see it with that Russian doll thing. You can see the 2 coming out and being part of larger platforms or groups. But at this stage, just all eyes on what they can do, investing that money effectively. And there's a good team on board there to be sort of stewards of capital.
Yeah, just one final question. This is sort of like a bit of sort of, for investors, sort of the high net worth sort of professional investors. How do you, with a sort of like slightly illiquid stock, the likes of Universe, and you said you put in, I don't know, 400 grand or something like that into it last year. How, given it's so illiquid, how did you manage to get that type of, bread into a particular illiquid stock? I mean, do you ring up shareholders and see whether they want to sell, or do they ring up you and say, "Look, Laurence, we want to offload a stake. Can you pick it up for us?" Is that how it works?
Not quite, Paul. And look, a key part of the way we work with this concentrated investment strategy is, the smart entry point, as we call it, is super important. It defines your returns on the way up, i.e., the price you get in. But almost as important is where's the liquidity, because you can't get stuck with a subscale position. It's just not economical.
Yes.
What that means is we tend to invest in two ways. One is a sort of what we call a primary issue. So, i.e. the RPS Group emergency raise last year, or Van Al, or convertible loan note into Northbridge or or National World. The other is what we sort of call secondary issues, but they're sort of block stakes. So we might buy into something when no one else sort of loves it anymore. And that's often part of the turnaround story. So Universe Group, we bought a block stake from a forced seller during COVID. Pressure Technologies 3 years ago, they've hit some headwinds in COVID, which wasn't in our original thesis, but that was when we lifted 10% of the company out of another fund manager. Do you remember City and Financial when they went? Yes. We took their stake in that at sort of distressed price. So liquidity is a key part of the thesis, and sadly, there's loads of companies we find that we love and think are going up, but there just isn't the stake available. I think I mentioned earlier in the call, I've been doing loads of work on the market prospects of one, but can't talk about it because we're not invested. The reason why we're not invested, we can't find any stock. We like to own 5 to 25% of the company. That isn't easy to find, especially when things are good, because obviously no one wants to sell. So it is a bit of an art and a dance that sadly you can't always execute on. And there's been quite a few sort of the ones that got away. DX Group was one. One of my colleagues was super bullish on that, but we never quite.
Yeah, Andy Brough got into that one. Andy Brough got into DX Group.
Yeah, I mean, ZAR was another. I mean, so it can be an issue. And I think, look, medium to long term, hopefully Gresham will have other funds that are maybe slightly more vanilla and traditional where, the ideas that aren't liquid enough for GHS, well, we've got a slightly less concentrated portfolio that thinks a similar way in the world that can do those. You
tend to play much in the IPO market, actually, do you, in the primary issue? Is that because of the pricing level?
I think there's quite a few fundamental things about IPOs that some of my colleagues won't agree with me on, but some of us in the team have a view on. If you look, the majority of IPOs actually lose money over 2 years. And there's some some are crackers and really exciting ways to access growing companies. But what we're always wary of, in GHS, we're trying to buy things when no one else sort of wants them and they're a bit unloved.
You sound like Warren Buffett.
IPOs tend to come to market, as you know, Paul. They're often an exit opportunity. So here's actually a good example. Van L, which we bought at 25p in COVID.
Yeah.
That floated 3 years ago at £1.10.
Yeah, I know.
And the devil in the detail was, it was a classic. It was the IPO wasn't really growth capital. It was a private equity investor looking for an exit. And instinctively, I don't really want to be buying things when other people want to sell them.
Yeah.
I want to buy them at the time when no one's interested in them. There's not much going on. And because I just think instinctively, if PE or someone's exiting, these guys aren't daft. You've got to be super wary that you're not becoming a bag carrier, so to speak. So that we have done a couple of IPOs over the years, but yes, I guess the hurdle's extra high because there's a slight wariness of why are you floating? What is it? Is the money just to bail out or fund existing debt and shareholders exit? All those things. If it's a genuine growth capital raise, and there've been some really successful ones. Ken Watton's great at picking them, my colleague. There's loads in his microcap portfolio, but it's just not our skill set or preference. When we're looking, things rarely IPO at a value opportunity, which is the sort of mindset of Gresham House Strategic.
And that's why it's nice to have a bit of sort of like optionality, spare cash on your balance sheet, such that because you don't drive always the timing you can get into these stocks. You've got a big stock watch list, and if somebody comes in with a nice sort of like bid or an offer, it comes in with a nice offer, then you sort of like, okay, we'll pick up a stake in it. Is that how it sort of like plays out? Yeah.
Yeah, it's in some ways there's an element of sort of special sits to it. We look for situations to get involved in where we can identify return drivers, both at really timing, at the earnings level, and then if those two things are right, they'll drive a better rating in the stock. Because we were talking about, if you try and buy things when they're unloved and misunderstood, and then sell them when everyone loves them, you tend to get a better rating on those shares you sell. IMI Mobile was the classic example. We bought that. Software company, 7 times EBITDA. They usually trade on 15. We spotted that arbitrage opportunity, worked with them to improve their R and comms, help them churn the register, change advisors, and it slowly re-rated over 3 years, and we got out. Sadly, it then got taken out at 30 times EBITDA, but we made super good returns on that for our investors.
You can't be too sort of like choosy. If you make a handsome profit, then you got to be happy with and redeploy, haven't you?
Yeah. I mean,
okay. Well, brilliant, Laurence. Thanks very much for your time. And I would strongly suggest investors have a look at Gresham House Strategic. I mean, I did just last night, and over the last 5 years, you'd have doubled your money if you were a shareholder. Plus, that's 15%, sort of like capital gain return. Plus, you've got a 1 or 2% dividend yield on top. So I think that's a stellar performance. So well done on that one, Laurence, and I look forward to chatting going forward.
Well, look, Paul, thanks for your time, and I've really enjoyed it as always.
Cheers.